Well, let's get a move on then and talk a little bit more in detail about the entire banking sector as a whole, as well as what the outlook is. Vinay Sharma is the equity fund manager, Reliance Nippon Life Asset Management, now joining in. Good morning and thank you so much for taking time out. Vinay, just let's get in a sense, you heard out my colleague Jayesh give us an insight as to what the outlook is on the financial sector globally as well as back home, and how there had been a lag vis-a-vis the Nifty performance, but the bounce back as well has been quite commendable. What's the sense that you're getting when it comes to the banking sector?
So, as you correctly said, financials have been a big underperformer over the last 2 quarters. And part of that was because of apprehensions around credit quality across the world and what will happen to the financial system stability and asset quality because of the COVID crisis. Now, because of the support that has been provided both by central bank across the world and the central governments, we have seen both in developed economies as well as in emerging economies that some kind of confidence is now coming back that the damage won't be as big as what was anticipated probably 3-4 months earlier. Even if you look at the commentary of some of the managements that have declared results in some geographies, commentary has been much better than what was anticipated. And to talk about India also, managements are now commenting that the kind of restructuring numbers or moratorium numbers or that were anticipated in the market might not come true, and the numbers might be much smaller than earlier anticipated. To add to that, collection efficiencies also are now getting back to those 90 plus numbers in many segments, and that is adding to the confidence. So it's a confluence of various factors. One, confidence coming back in financial stability across the world. Second, valuations were relatively cheap compared to most sectors because financials had underperformed almost 70-80% of the market over the past 2 quarters. And third, specifically talking about India, if you look at the major constituents of Nifty Financial Services Index, most of the constituents today are more conglomerates in nature or more holding companies in nature rather than just lending entities. And a large part of value actually comes from those insurance, asset management, general insurance sort of subsidiaries. And if you look at pure lending entity valuations, the lending entity valuation had probably reached the kind of figures that we have probably seen only once or twice in last decade or so. Therefore, to us, it seems like financial services are a good place to be for the medium term. Valuations are supportive, and fundamentals are turning out to be better than what was anticipated a few months back.
Okay. So give us a sense as to where you see the leadership really coming in. Do you think that it will be the large private sector banks that would be best placed to really play the sector going forward, or would it be a diversified mix across the BFSI space?
So if we were to pick one segment in the entire financial sector in India, we totally agree that the large private sector banks are the best place to be. And there are various reasons for this. One, as I already said, if you look at most of the large private sector banks in India today, they have become sort of holding companies or conglomerates in a way. And a large part of value is coming from non-lending entities as well. And lending entity value, as I said, is fairly low compared to their average history. Therefore, that is one reason. The other reason is if you look at in any crisis situation, whether it's liquidity or asset quality, generally these private sector banks find it easier to raise both capital and liquidity. And therefore, they are able to gain market share disproportionately in such periods. This has been going on for a few years now. They were getting market share from PSU entities. They have started getting market share from the NBFC counterparts now. And we believe that this will continue for many years. One, because they have the easier access to capital and they have the easier access to public deposits compared to many entities in the system. Therefore, we totally agree that private sector banks are the way to go, and especially among them, the large private sector banks will reap disproportionate benefits in any period of crisis.
Sure, but Vinay, given the lack of performance that we've seen over the last year, is there no change that you're making or looking to make in terms of the weightage? Because we really haven't seen that action or that performance, that return coming in on those private banking names. So when you're looking at a forward-looking scenario, I mean, how far are you factoring in before we actually see them deliver?
So it is going to be a volatile journey. I guess we all know that the next 2-3 quarters are going to be fairly volatile in nature. One, because the actual numbers would only come out in either the January or the March quarter when these banks announce their restructuring numbers. And some of the damage to the system because of the COVID crisis would also be clear only in the next 2 or 3 quarters. So it is going to be a volatile journey. But if you look at the fundamentals today, as I said, almost more than half the valuation today of most of the banks is coming from non-lending entities. Those non-lending entities have actually gotten impetus from the crisis, because insurance, if you look at it, some of the segments have actually benefited from the crisis, especially awareness about health and term insurance would have only gone up in the system because of the crisis. Similarly, asset management has become a fairly stable, structural sort of growth story in India. India is still hugely underpenetrated when it comes to investing in financial assets. And therefore, that story is also likely to continue for a long time to go. So if you look at the pure lending valuations, they are reasonably low today. There is reasonable margin of safety built into them. And therefore, we don't feel a need to change allocations towards large private sector banks in a big manner today. Indeed, we are, as I said, in terms of the medium-term outlook, we are more positive on the large private sector banks in the entire financial space than any other segment. Both a combination of valuations as well as fundamentals. Both look fairly attractive to us. While it is true that delivery might take a few more quarters to come, because maybe 2 or 3 quarters market would be apprehensive about the asset quality numbers and what kind of restructuring numbers actually come out. And while India has seen a large corporate asset quality cycle over the past 5-6 years, there are apprehensions that India would see a retail asset quality cycle now, and those apprehensions are partially true as well, in our opinion. But the extent of the damage that the market anticipated, or the market participant anticipated a few months ago, we are now fairly confident that the extent of damage is not going to be to that extent. And therefore, valuations have become fairly attractive, because valuations were kind of factoring in a much larger negative numbers in asset quality and restructuring than what we believe would actually come out. Therefore, we are fairly sanguine on the entire private sector space, and we don't feel a need to change large allocations in that space.
Sure. You touched upon, of course, watching out for any kind of asset quality moves that come in over the next couple of months. Just to get a sense, though, from you, outside of the large private banks, if we were to look elsewhere among the financial baskets, select NBFCs, or for example, where would you feel confident about about the returns of the next, even over the short term?
It's very difficult to forecast short term, and if you look at some of the other entities, you will have to segregate between insurance and the lending NBFCs, because insurance actually has not seen any sort of de-rating because of the crisis. And as I said, the crisis has only structurally helped insurance growth in a way. So therefore, insurance and lending NBFCs are two different segments. In lending NBFCs also, there are various segments that you will have to segregate, and it's very difficult to give an answer based on them as a group. For example, over the past few years, gold financing has structurally done very well in India, in the country, and probably it will continue to do well. The segments we believe that would have suffered because of this crisis are either the segments which lend to the urban poor category, and categories which lend to sectors like real estate, probably a little bit of travel, the non-secured urban poor part of it. So those are the segments that one has to be wary of. But again, there one has to be very selective and bottom up in finding stocks, because what has happened is valuations have corrected a lot, and most of these entities today, as I said, for banks also, these entities also are trading at almost their all-time low valuations compared to last 5-10 years. And therefore, one has to be selective. If there could be attractive opportunities even in lending NBFCs today, and we are starting to look at them more favorably than what we have looked at them probably over the past few years. Again, even in NBFCs, there are the entities available today which are sort of conglomerate in nature, and where the entire valuation is a combination of one lending entity plus insurance plus a few other entities. And those sort of entities have inbuilt margin of safety built in, because other than the lending entity, most other entities have not been impacted by the crisis, as I said, for banks also. So in a nutshell, we believe one has to be very stock specific when it comes to NBFCs. And insurance, one probably valuations have not corrected so much, and relatively it might not be the cheapest place to be in the financial sector.
Sure. Okay, Vinay, good to have you on the show. We'll let you go on that note. Good speaking with you as always.
My pleasure.
The market still lying soft, still just hovering around sub that 11,900 mark. The breadth, though, is a little disappointing, given that it started off well in favor of the advances, has completely turned tide since. Hero MotoCorp, Naukri, JSW Steel, PVR and Coforge are the ones which are under pressure. Add to that some of the financials like a Manappuram, Bandhan Bank, which are also in the red as we speak.